Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but to teach you how everything works here. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. After an agonizing period where Wall Street decided it was done with one of the greatest growth stories in history, artificial intelligence and everything attached to it, today we got a reprieve. Maybe even a second wind that showered money on the cohort. For those of us with positions that rely on the AI data center build-out, like my charitable trust, do you know that this was one of the best days of the year? Although that wasn't fully reflected in the averages. The Dow advancing only 183 points, S&P gaining 0.88%, but the Nasdaq did jump 1.31%. I gotta say, today was a real relief, because owning the AI stocks has been a very rough ride lately. First, we now realize that there may be not enough money to go around to keep the data center build-out going. Lately, we've found real obstacles to building these. Everything from a shortage of workers, lack of materials, not enough power, to the fact that the stock market's now punishing the hyperscalers for their ambitious expansion plans that were once lauded on Wall Street. These companies keep spending fortunes to keep up with each other, and Wall Street can't take it anymore. At the same time, the AI theme lost its luster, didn't it? Buyers moved on to other, more exciting areas. The consumer's resurgence out of nowhere, that's an exciting story, for example. It's ignited retail, anything connected to discretionary spending. And that's what drove, say, the stock of Carnival Cruise almost 10 points higher today on greater numbers that it released just this morning. And also, by the way, they reinstated the dividend. I've always been partial to cruise lines because they're so inexpensive, and Carnival Corp offers a real bargain. That's one of the reasons why the stock is exciting to people. Meanwhile, there are plenty of IPOs and acquisitions which have caused furious buying of the bank stocks. We saw a very positive article about Wells Fargo in the Journal. Goldman Sachs up 56% for the year, now eclipsed most of the performance of the Magnificent Seven. There's a reason for that. Goldman Sachs may be growing faster than almost all the stocks in tech, let alone the Magnificent Seven. And by the way, at a lot less risk, which is what really matters. These financial and consumer spending companies just keep delivering better and better and better expected numbers as expectations are incredibly low versus the monstrously high expectations for anything related to the data center. High expectations can be a real killer of tech stocks, and expectations are staying way too high. Now, the good news. The good news is that the year of magical investing has ended, so almost every one of the speculative stocks, meaning the quantum computing, the nuclear stocks, the undercapitalized data center builders, the bogus Bitcoin extensions, and alternative power companies, they've all gone out of style, thank heavens. I find those groups nauseating because so many of you were losing money. I was doing my best to try to get you out of them, but I didn't. What really mattered today, though, is the possibility that funding for the data center build-out, something that was beginning to seem chimerical, has tantalizingly returned to a degree of certainty. The possibility that there are many pools of capital that may still want to get into data center, into AI, could drive a whole host of down-and-out tech stocks higher. Rather than limping into 2026, these stocks have erupted.
House of pleasure.
It's very unexpected. But can it last? This is the question. Look, I've been a hypercritical person when it comes to the data center promoters of late. Their big dreams have started to sound more like nightmares. I've questioned the way that some of these companies sound so certain when certainty seems to be in very short supply. I don't like deals like the companies are doing where one company gives another company money and the recipient then buys product from the donor company. These are called lazy Susan deals or circular deals. They often hide the real weakness that's going underneath. You don't discover that until it's too late and you lose a lot of money. And I'm trying to protect you. My confidence, perhaps, as well as yours, has been sorely tested by the news flow, which has been very negative. So let's do this. Let's talk about what needs to happen, what could go right, a little more optimistic to get the data center theme back on track. Right now, the biggest ambush in this market comes from Oracle, the debt-laden software company turned data center builder. They've got a huge client called OpenAI, the privately held company that's been a pioneer in artificial intelligence and the bots that go with it. You know it as ChatGPT. Oracle's charged with building out $300 billion worth of orders for these guys. What a great story. An old-fashioned tech company reinvents itself as a data center builder and crows about it. Not only does Oracle have the huge order from OpenAI, they got another $223 billion in orders from other companies. Oracle has put the potential revenue into something called RPO, or remaining performance obligation. Most of the time, that's almost as good as money in the bank. The OpenAI order, the revelation, initially sent Oracle stock from 241 to 345 and change in a single September trading session, although it closed that day at 328. Many other stocks in the data center complex took off, too, in sympathy. Of course, Oracle had to raise the money first, so they hit up the bond market for $18 billion, and that's when the problem started. Bonds can be insured with what's known as credit default swaps, which you can actually use to bet against those bonds, too, even if you don't own them. If you fear that Oracle might default, you buy the credit default swaps. The value of Oracle's credit default swaps soar when the value of the bonds goes down, or the perceived value. This spike was picked up by the media, and it derailed everything. Suddenly, Oracle's grand plan seemed impossible to pull off, and we now believe that the whole data center complex may be stalled. Oracle stock went into free fall, going from 328 down to 178, where it landed 2 years ago, until it went up a little bit today. At the same time, OpenAI, which is counting on the build-out to stay ahead of all comers, chose not to address the situation except by leaking to the media that it could still raise an endless amount of money because so many funds want a piece of the business ahead of the potential IPO. Oh, and they also mentioned a possible government backstop, which was incredibly discouraging, although they later walked that back. This week, we heard from the leaks that OpenAI could be raising as much as $100 billion at a valuation more than $500 billion, maybe $657, ultimately $830 billion. Then but there was a weird stair step. They said it was going to be $750 billion just a couple days ago, and then it was just $830 billion yesterday. I mean, that's terrific if it has veracity. And the reason I question is that every day it kind of went up a little, but nothing really happened at the company. Which brings me to what needs to happen now. First, OpenAI should strike while the iron's hot and try to raise $200 billion at a $1 trillion valuation. That trajectory that we got this week would seem to allow that. To me, that seems like the only way forward for them. With that fundraising, they can pay Oracle the money it needs now to build out these data centers. At that point, every other hyperscaler will have to keep spending on infrastructure to keep up with them. That's how we get to where all these data center stocks, from Vertiv and Caterpillar to CoreWeave and Broadcom, can reignite. Now, a lot of those stocks were up big today. And that's how we stay on top in the most important race in the world. Could it happen? You know what? At first, I thought it was pie in the sky, $1 trillion, $200 billion. But you know what? Maybe it is a possibility. People are still very excited about this group. Even if OpenAI raises, say, $100 billion now in a private round, and then comes back for a public round for another $100 billion next year, the data center theme could continue to hum. Of course, if OpenAI can't raise enough money, then we just reverse everything we saw today and we go back down. That's the way it works. I'm optimistic that OpenAI can raise the money, even as I don't like the way they're doing it with these leaks and the forced March valuation. I do think that they can pull it off. OpenAI does have monster hubris, though. It has no idea how to tell its story. It's way too self-assured. Management has zero humility. This could be a humbling moment, or it could demonstrate that they're right to be arrogant. I'm not sure which one it is. But the bottom line, no matter what, OpenAI needs to raise a lot of money, and it needs to raise it now, or else the whole data center edifice will go down and stay down. But if they raise $100 billion in the next couple of weeks, then we will live to play again, and we'll see plenty more days just like today.
That was easy.
Let's go to Patsy in Texas, please. Patsy.
Oh, Mr. Cramer.
Yes.
What's your opinion on Dell? Ever since I bought it, it started to slide, and it keeps going down.
All right, you're right to worry, because a lot of people are concerned that their parts themselves have gone up a lot, and their raw costs are going down. I think Dell can fall from here. I think it can fall, but not below much, maybe 115. 110, and you should buy it because Michael Dell will be in there buying it with you, and he is a very smart fellow, and he's not going to let those component costs bother the bottom line too much. And the stock is still up for the year. Let's go to Mary in Idaho. Mary.
Good afternoon, Jim. It's been a minute since last time I talked to you.
Okay.
And I want to congratulate you on your 20 years with Mad Money, the publication of your book, which I downloaded an audio copy of about 10 days ago.
Oh, great.
As well as all you do with the investing club.
Oh,
I really believe that you would, any investor would benefit from any or all of those items.
Oh,
so
thank you.
Congratulations.
Thank you, Mary. I mean, I got a long weekend. I have not had a weekend where I haven't had to work in a long time, and I really appreciate your comments. It makes me feel like it's okay. It's all worth it.
It is worth it, but you do pay a price for it.
Yes, I do. Thank you, though. Thank you very much.
You're welcome. The stock I'm calling about has been in my portfolio, which is very small, for a while.
Okay.
And it's a company I do a lot of business with. They have a wonderful, large, quality product line. Their prices are in line with others in the industry. I've looked at their balance sheet. I've listened to their earnings calls, although I did miss this last one. And their customer service is absolutely incredible.
And which company is this, Mary? Which company is it? Which one?
It is Chewy.
Oh, okay. So CNBC was on the show recently, and I got to tell you, I totally agree with you. But we are fighting a trend. People feel that Amazon can't be beaten, and I think that's wrong. Chewy's got a lot of ancillary businesses that will really help them. I'm with you. I'm a buyer of Chewy. All right, this could be a humbling moment for OpenAI, or maybe they pull it off. I don't know. I just wish they'd just stop being... I wish they had less viewers. How about that? And let's leave it at that. That's not a mean way to put it. Okay, anyway, Mad Money tonight. The government shutdown caused all sorts of data to be delayed, so I'm going straight to the source with Paychecks to get a sense of the employment situation in our country. Then we are wrapping up our homework assignment for the year by taking a closer look at biotech company Cura. And we're playing America's favorite game, Am I Diversified, where I survey your portfolio to see if it passes the test, and we're using the new rules that I put together for you and how to make money in any market. Stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.